Hello everyone, it's Chris. In this video, we are going to talk about Mastercard because the company just reported earnings and the stock is up plus 4%. These were perfect earnings. This was a perfect earnings report. And in this video, I want to talk about the report. I have some notes and some comments to make because how can you put it? It's an A+ report. It's a perfect report. It's a 10 out of 10 report. Absolutely fantastic, and I want to show you why. I have some notes, I have some comments to make. We'll go through the numbers together. I have some questions, and also for the second part of this video, we will go through the earnings call together. I want to react to the earnings call because I have some questions that were left unanswered while reading the report. A couple of questions, and I want to know what is happening here. Because if you are following the story with Visa and Mastercard, these two stocks are down for Visa and for Mastercard because some potential laws that will be passed. So swipe fees that will be impacted, but also interest rates on credit cards, debit cards that may be impacted. What is the probability of it happening? What are the risks? We will maybe have more information during the call. So together we will listen to the call. In case this is your first video from this channel, welcome. My name is Christophe Noor. I've been investing in the stock market for almost a decade now, and I have achieved a performance of 25% per year. And full disclosure, I am a shareholder of Mastercard. This is roughly, I think, 11% of my portfolio, so a core position, and I love to see this report. So let me go deep into this report right away so we don't waste our time. This is the Q4, fourth quarter, and also the results for the full year of 2025. Let's see what the CEO has to say. 2025 was another strong year for Mastercard, with net revenue up 16% year over year and 15% on a currency-neutral basis. We are executing and winning with programs like the Apple Card and robust growth in value-added services and solutions at 23% or 21% currency-neutral. The overall macroeconomic environment is supportive, and we continue to see healthy consumer and business spending. That, together with trusted technology, constant innovation, and deep partnerships, powers our performance. What he's telling us is business as usual. The economy is in a good shape, and we don't expect a major deceleration for 2026. Focused, agile, and diversified, we are well positioned for the opportunities ahead in 2026. So, let's look at the key numbers. You will see that the time we will spend on this report can be summarized very fast, very quickly, and I don't have many comments to make. This is why I am invested in Mastercard. It's a kind of stock you can monitor from a distance and nothing is really happening, but it's always good to track these numbers. So let's see from the revenue point of view. Revenue on a GAAP basis is up 18%. Even if you adjust for the currency, this is still good. You had a small tailwind, a small help from the currency. If you adjust for the currency, it's up 15%. Anyway, still good. For operating expenses, they are up 10%. So, beautiful operational leverage. Revenue is up 18%. The costs are up 10%. So, margins go up. That means the operating income is up 25%. Can you name 10 businesses that can consistently grow the EBIT, the operating income, by 25% with this kind of visibility? It will be very hard. And Mastercard is in an extremely lucky position of being in a duopolistic position. They can have any margin they want and they can have any cost they want. So operating income is up plus 25%. Even if you adjust for the currency, up more than 20%. The operating margins are up from 52% to 55%. And so this is good for profitability overall. And what is bad here, I put it in red because it's bad, the effective income tax rate. The tax rate went from 14% to 16%. So a small increase in taxes. So overall, the net income is up 22%. It's a slowdown compared to the operating income. Okay? You do a little bit of buybacks, 2% buybacks, which means the diluted EPS, earnings per share, are growing by 24% on a GAAP basis without any adjustments, right? If you adjust for the currency, you are up 20%. And if you make some adjustments here and there, you have a revenue up 18% and earnings per share up 25%. Anyway, the adjustments they are making for their non-GAAP results are irrelevant and very small. And for Mastercard, you can look at the GAAP results, the official results, and they are very, very, very good. This is exactly the reason why I recently invested in Mastercard in 2025. Just this. Going into 2025, I wanted to make some changes in my own portfolio. I wanted to move away from capex intensive businesses, and I wanted to have a portfolio filled with asset-light companies with pricing power and operational leverage that are doing buybacks. Mastercard has operational leverage. Mastercard can grow revenue double digits for almost infinity. Mastercard has net margins, operating margins of 50%. Mastercard can do buybacks every year. They have done buybacks for 20 years in a row. Mastercard can grow the earnings per share at 20% per year. These are all the reasons why I am invested in Mastercard. And later on this video, we will talk about the valuation. I think the valuation is quite compelling right now. This is the reason why I bought more. I bought the dip very recently. So if you go into more details into what is happening with Mastercard, basically for Mastercard, you have two segments. The net revenue is going up 18%, but you have two segments. The payment network, so cards, the revenue is up 12%, and the value-added services and solutions segment that is growing by 26%. So first of all, if you look at the overall revenue, up 18%, this increase includes a 1% increase from acquisitions. I think they acquired the company for stable coins, right? And this is one of the questions I have when I look at this report. What is their acquisition? They don't mention this acquisition. I read a couple of weeks ago that they recently made an acquisition when it comes to a stablecoin company, a new tech company, but I wanted to have more information about the acquisition. Anyway, out of an 18% growth rate, 1% is because of an acquisition. Remember this. For the first part, for cards, up 12%, business as usual. For the value-added services and solutions, this segment is growing fast. This segment is growing 26% year on year. You have a 3% increase that are coming from acquisitions. And what is the acquisition? This is a question. Second comment I have to make, the value-added segment grew 26%, making the fourth consecutive quarter of acceleration and now representing 44% of total net revenue. And this is one of the key differences you have compared to Visa. Visa is mostly focused on payment network. Mastercard is a little bit differentiated because they have this value-added services segment. And if you go to financials, you will see the splits between these two segments. I'm using a website called Fiscal AI here, and you can see that the company has two segments. The payment network revenue, you click on the growth rate, and the value-added services growth rate here. This is what you have. You can look on a quarterly basis, you will have a lot of information. Here we go. In red, you see the growth rate for their payment network. This is their segment growing 12%. Nothing really surprising, right? And in blue, you have the other segment that has always grown more than the red line. And now it is accelerating. You have a new segment that is also very profitable, that is now growing 26% per year. This is immense growth ahead. And you can guess that in the future, it will get more impact. You can see on Fiscal AI the common size of each segment. This is what you have, and this is what you have. Very good. So, on a yearly basis, what do you have? Anything can work actually. Since 2022, so for the past 3-4 years, this is the importance of revenue for each segment. In the past, this value-added segment, services segment, was 35% of the revenue, and it is slowly growing and growing and growing to 40% of the revenue. And if you go into quarterly, you will have even more details. It's now 44% of the revenue, almost half, and it is growing 26%. What it means is if they keep this growth rate of 26% per year, if they keep growing more than the cards payments, network payments, it will become the majority of the revenue. And it will lift the overall growth of Mastercard. So one of the reasons I bought Mastercard and not Visa is because it is growing faster. And as the years go by, it will grow even faster relatively to Visa. So for the same valuation right now, if you have, I had the choice between Visa and Mastercard. Visa has better margins because they focus on their niche of payments, okay? But Mastercard, for the same valuation, is growing more. And I want my portfolio filled with companies that can grow earnings per share at 20% per year. Mastercard, in my opinion, they have a better chance of growing earnings per share at 20% per year compared to Visa. So this is the reason why I am invested in Mastercard. I hope that's clear for everybody. So the blue line will cross 50% one day or another, and this will get them some diversification. They don't share the margin profile of each segments, but from my research, the margin profile is extremely good for both of them. The value-added services segment has lower margins than the payment network, but this is fine. I mean, we are talking about extremely high margins. Okay. By the way, you see me on Fiscal AI. You can try Fiscal AI. I have a discount code in my description to get it 15% cheaper. Use my link, click on it, register. You can use the website completely for free for 2 weeks without putting your credit card. And then if you like it, you stay. And if you use my link, it will get 15% cheaper. So you click on my link in the description so you can use Fiscal AI the same way I do. So let's go back to the report. The value-added services segment is getting more and more important and growing 26%. This is huge. This is huge, actually. You have an acquisition. I want to know more about what is this acquisition. And also, they talk about their operating expenses that are up 10%. This is operational leverage. Also, you have some small adjustments. They say, excluding the impact of the special items, adjusted operating expenses increased 14%. During this quarter, you had some adjustments to make when it comes to Mastercard. And you can scroll down on this report. You will see these adjustments. I analyzed all of them, and I don't think they're particularly relevant. You have small adjustments, small reconciliations, but despite all these adjustments, the story is pretty clear. Even if you take into account all the negative adjustments, you have revenue growth of 18% and costs growth, expenses growth of 14%. So even in a worst case scenario, you have operational leverage. So this is still good. The margins are still going up. The other thing that is changing is the effective tax rate that went from 14% to 16.7%. Why is that? Why is the tax rate growing? Is this a one-off event or is it a new plateau? These are the kind of questions I want to ask when I'm looking at this kind of change. Because, 2 or 3% change is significant. So the tax rate was higher in 2025, they say primarily due to the net tax effect from our Singapore operations, which includes the 15% global minimum tax Pillar 2 rules that took effect in 2025. For many companies, this is the case. Additionally, a change in our geographic mix of earnings contributed to the higher effective tax rate, partially offset by net discrete tax benefits, which means this is a new plateau. Don't expect the margins to go up this quarter and then go back down. I think this is the new plateau. Actually, I can check live what has been the effective tax rate of this company on a quarterly basis for the past 10 years. For the past 10 years, this is the tax rate we saw. So For some reason, in March 2022, the tax rate was 5%. Anyway, the median is 16%. So we are exactly at the same point as the median. And if you check last year, so December 2024, the tax rate was 14. So it's not that this moment, this quarter today is not normal, it's that last year was not normal. Last year, you had a low tax rate. You had 14% compared to the base rate of 16%. Fair enough, don't expect the moon, don't expect to come back at 14%. Okay? Which means the year-on-year change for 2026 will be good. Okay? You will not have this negative impact from taxes. By the way, guys, the tax rate is going up and the net income is still up 22%. The report was spectacular, spectacularly good. If I scroll down, I don't have any other things to say. I mean, the report was pretty clear. They talk about their full year adjustments and they talk about their capital allocation decisions. What is their capital allocation decision? Well, during the fourth quarter of 2025, we repurchased 6 million shares at a cost of $4 billion, and we paid $500 million in dividends. And a quarter to date, so for the start of 2026, they have already repurchased 1 million shares at a cost of $700 million. So they are still doing buybacks today, and you have $17 billion of buyback program that is remaining. If you look at history, the company has always repurchased their shares. You can look at the operating cash flows of the company. You can look at the buybacks of the company. You can check the blue, you can check the red. What I want to show you is the red is the operating cash flow the company has generated for the past 10 years. And in blue, that's the buybacks. Every quarter, the company is doing buybacks. That's part of their DNA. And what they are telling us is we are going to continue, even in 2026. This is something that I love to see as a Mastercard shareholder. The capital allocation strategy of the company is extremely simple to understand. They want to do a little bit of buybacks, a little bit of dividends. As you can see here, I can put the dividends in orange here. And that's basically it. If you look at the capex, the company has no capex. The capex I can show you here is in purple. You can zoom in. There is almost no capex. Look at this. This is the purple line here. The capex is getting ridiculous. You have some intangibles. Software capex. This is it. In green, negligible. I can remove buybacks. I can remove the dividends. This is the capex, the sum of the purple and the green. The real capex of the company compared to the operating cash flows. The company has no capex. The company has no costs. They can run this business model very profitably for years and years and years. This is an exemplary capital allocation model. So every year they are repurchasing, 2% of their shares. You can click on the percentage change. You scroll down, diluted weighted average shares. What is the buyback? So some years in 2018 they were buying back 2% of their shares, and then in 2020 they bought back 1% of their shares. In 2023 they bought back 2% of their shares, and now they are continuing to buy back 2% of their shares. Every year they are doing buybacks. They don't need to offset dilution because there is no SBC. The capital allocation strategy is extremely simple. By the way, if you want to become a better investor and improve your performance, I have a coaching program. It gives you the exact method I've used to generate 25% per year for almost a decade. More on that at the end of the video. And they're doing some dividends anyway. Let me scroll down. And yeah, this is the adjustment. Some losses they are adjusting. Anyway, this is good. So that's it for the report. The report was a 10 out of 10. Frankly, that's an A+ report. Nothing ever happens for Mastercard. This is the reason why the stock is up 4%. I can totally understand. It can be up by 3, 4, 5, 6%. That would not matter at all. The business is firing on all cylinders, and maybe they said something even more bullish for the call, because we had a call when the market was open, and it seems like the market loved it. So now you have a few worries for Mastercard. One question is, what is their acquisition? What is this acquisition that is incremental to your revenue growth? Two, the big lows. What are the odds that the Congress, the Senate in the US implements laws that will hurt the economy and credit cards and swipe fees like we have in Europe? So what do they have to say about this one? Maybe the ecosystem of credit cards will change. What will be the impact? How do they see the situation? In case these laws pass, how will the management team react? This is the kind of things we want to monitor for the earnings call. Before we go through the earnings call, I want to show you the valuation of Mastercard. I want to show you the price and the valuation today. If you look at the price to free cash flow for Mastercard, as we said, this is a business that can grow 15% per year, 20% per year. I mean, they are doing it right now. You have a price to free cash flow of 28. So a price that is reasonable for a business that is now perfect. I mean, this is a definition of a wonderful business available at a fair price. And this is the reason why I very recently bought the dip on Mastercard. I am actively buying more, and if the stock price continues to drop for some reason in the next few weeks, I think I will buy more, because we are talking about an exemplary business model that is improving their margins. They are growing double digits, and they can continue to grow double digits for years and years and years and years. The two things to monitor are the two lows, but if they don't pass, I mean, the business can grow for 10 years in a row. And if you use a DCF, you can estimate an intrinsic value of the business. I'm using the DCF model from Stock Unlock. I also have an affiliate link in my description if you want to use the website for cheaper. It is the best DCF model I have found on the internet. So I highly recommend you use Stock Unlock, even if that's just for the DCF model. Literally, use my discount code. It's 10% cheaper and will save you some money. Anyway, if you think the free cash flow of the business can grow at, let's use 15%, ballpark, if you think the free cash flow can grow at 15% per year, and if you think they deserve a price to free cash flow of 30. By the way, I can show you what has been the average and the median price to free cash flow of this business. We are at 35 and 34. Now the price to free cash flow is at 28. So we are below average when it comes to multiples and valuation. So comparatively speaking, relatively speaking, we are a little bit cheap. If you think the price to free cash flow they deserve is 30, this is what you have. Dividends is put 0, and buybacks, yeah, we said they are doing buybacks of 2% every year. I just showed you the chart. If you think free cash flow will grow for the next 5 years at a rate of 15% per year, the business has no multiple expansion, it stays at the same valuation, price to free cash flow of 30, and they are doing a buyback program of 2%, then if these are your assumptions, today the stock is 40% undervalued. And if you buy right now, you can expect a CAGR, a compound annual growth rate of 17.5%. The fair value of the business is $750. And now the stock price is $550. $200 of alpha. If you buy right now, today, you can make 17% per year if these assumptions are correct. This is a very simple opportunity I am seeing right now, and this is why I am actively buying the dip right now. Now I want to show you the earnings call of the company if we have our answers to our questions. So second part of this video, here we go. Let me put the mic,
Julianne.
and it will work. Normally it's 1 hour long. I will accelerate a little bit the speed, and I think we can start. So take a cup of coffee, take a cup of tea, leave a like to the video, subscribe if this is your first video from this channel, leave a comment. But I mean, let me know if you like this format of earnings report plus earnings call, because I'm loving it actually. Sometimes I'm sharing my data, Google Sheet for Mastercard. The earnings report was so good, it was unbelievable. Let me know if you like this format, but anyway, let's start.
Good morning, everyone. There was a lot of activity to close out 2025, and it's been a fast-paced start to the new year. In that spirit, let's jump right in. My headline for you today, we continue to deliver, and 2025 was another very strong year. For the fourth quarter, net revenues were up 15% overall, with value-added services and solutions net revenue up 22% versus a year ago on a non-GAAP currency-neutral basis. Our consistently solid performance is driven by several factors. First, we are focused. Our strategy is clear, and we're executing against it. We're making strong progress against each of our strategic pillars and benefiting from the virtuous cycle across our payment network and services offerings. Second, we're innovative and agile. We spearhead the payments evolution. At the same time, environments shift. Customer needs, technology, regulation, so we adapt. And we prioritized, ensuring we have the right capabilities and skill sets. Recently, we completed a strategic review of our business. This will result in reductions in some areas and roles, but lead to further investment and increased focus in others. And finally, we're diversified and differentiated. Our business extends across geographies, spend categories, and payment adjacencies. The diversification of our business means we benefit from a wide range of growth drivers which make us more resilient. As we enter 2026, geopolitical and macroeconomic uncertainty persists. We will continue to monitor and work to navigate just as we have successfully done in the past. But for now, we remain optimistic and confident in our execution and the fundamentals of our business. Looking back at 2025, we won hundreds of new issuing deals and expansions globally. This doesn't just happen. It is the result of our dedicated sales force, technology, and differentiated value we deliver to our customers. I will share a few highlights from this past quarter. In the US and Canada, we extended our long-standing partnership with Capital One, where we renewed our partnership in credit, and we will be the network for a large portion of newly acquired credit accounts.
This is new and maybe not priced in. The renewal of a partnership with Capital One.
And across their
You had some rumors that this partnership would fall apart, and guess what? No, partnership is still on.
Business, Capital One will continue to use several of Mastercard's services. In Turkey, Yapı Kredi will migrate nearly 10 million cards across their consumer credit, debit, and affluent portfolios to Mastercard. Our consulting and marketing services will be used to support the end-to-end portfolio conversion. In Latin America, Scotiabank chose Mastercard as their network partner in Mexico, Chile, and Uruguay. Why? They see Mastercard security, loyalty, and analytics offerings as key to fueling their growth. This builds up on our strong relationship with the bank in Peru and the Caribbean markets. In South Africa, our modernized real-time payment switch is a key factor in us signing exclusive deals with several players in the market, including Nedbank and Standard Bank. These wins position us to increase our share in the market by multiple points. And we continue to win in affluence, so important. We have secured more than 60 new affluent programs in 2025 across the world. Our drumbeat of wins continued this quarter with new deals secured with PicPay, Cicub, Sysprime in Brazil, and Nedbank in South Africa, which I just mentioned. We're seeing the same momentum in co-brands with leading merchants and digital players. Earlier this month, it was announced that Mastercard will continue to be the exclusive network for the Apple Card, which will transition to JP Morgan Chase as the issuer in approximately 24 months. We supported the launch of this industry-leading co-brand nearly 7 years ago, and we are excited to support its continued success. We won the Walmart and Sam's Club co-brands in Mexico in partnership with Invex Banco. We renewed our partnership with Barclays, supporting its US co-branded card programs and its Tesco Bank card programs in the UK. And we partnered with Amazon and Emirates Islamic to launch the Amazon credit card in the UAE. As I said, we remain focused on driving long-term growth across each of our strategic pillars. In consumer payments, this quarter was about continued innovation and focus on driving incremental growth. Our drumbeat of wins I just mentioned shows that Mastercard is preferred over alternative networks. Banks chose Mastercard because of our global acceptance, our consumer protections, strong security, and digital capabilities. It's also about our dedicated teams and our commitment to driving mutual growth. We work with our existing customers to optimize their portfolios. By using our advanced analytics and AI capabilities, we help clients activate their cardholders, drive top-of-wallet behavior, and increase approval rates. And it works. We're driving more transactions of our network and in key categories, think digital or cross-border. In looking at digital commerce alone, we've seen approval rates increase by 270 basis points in the last 5 years. Now think about what that means when applied to Mastercard's global payment network. Last year alone, we switched more than 175 billion transactions. That's a lot of potential to further optimize.
Yes.
We now switch more than 70% of all Mastercard transactions globally, an increase of 10% since 2020. More switch transactions result in more data and more opportunity to sell services and so on. All of which allows us to help our partners drive top and bottom line growth, enable seamless and secure experiences for our cardholders. This is the virtuous cycle in motion. The payments industry continues to evolve. Stablecoins and agentic commerce bring new choices to pay and get paid.
By the way, a lot of people that are bears about Mastercard mentioned that Visa and Mastercard will get replaced by stablecoins. You have a few videos right now on the internet that I can recommend. Some of them from Steve Eisman, how stablecoins are trying to disrupt the industry, and how it's not the first time somebody tries to disrupt Visa and Mastercard. Most of the time, historically speaking, when there is a new technological change, Visa and Mastercard embrace this new change. As you can see, maybe they will talk about their stablecoin acquisition, maybe they will talk about something else, and most of the time, Visa and Mastercard thrive out of this new technological change. So for all the people that worry about stablecoins, it's harder than it looks to displace Visa and Mastercard. You have had a duopoly for many decades, and most likely this duopoly will be here in many years to come.
We are leaning in, just as we have with neobanks, digital wallets, and installments, and so on. For us, stablecoins and agentic commerce are emerging opportunities, ones where Mastercard has a natural role to play. We have been active in the digital asset space for over a decade. Most use cases for crypto and stablecoins today are for trading and the like. For us, it is another currency we can support within our network.
Exactly.
And we've made good traction enabling the purchase of these assets, facilitating transactions, and supporting stablecoin for settlement over our network. Trust, interoperability, and global acceptance are key in all payments. That's where we come in. This quarter, we have supported co-brand partners such as MetaMask as they scale across geographies. We partner with co-brand partners to extend their offerings to new customer types. Gemini brings their success in the digital asset space to launch the first business-focused stablecoin co-brand. And we continue to expand our settlement capabilities, now working with Ripple. Moving on to agentic commerce, where AI-powered agents assist or act on behalf of consumers throughout their commerce journeys. For us, agentic commerce represents another avenue to enable payment choice with the same trust that we always deliver. It's early days, but we are ready. You remember, last year we launched Mastercard Agent Pay, a framework designed to foster trust in agentic transactions. We have now enabled our US issuers to participate in Agent Pay, and we are working to enable our global issuer base by the end of the first quarter. As more agents come on board, there will be more opportunities for consumers to experience a truly seamless commerce experience. We're actively working with ecosystems participants to adopt agentic commerce across all regions. I'll share a few highlights from this quarter. In Asia, we're partnering with Anthem on card-based tokenized payment solutions for agentic payments. In the UK, we're consulting clients such as Lloyds Banking Group, Elavon, and Santander on agentic commerce innovations. And in the UAE, we're piloting agentic payments with the leading retail and entertainment group, Majid Al Futtaim. And with banks,
and look at this. If you go to the news operation, I wanted to see if you had some piece of news when it comes to stable coins. And you have some stablecoins. It's not as if Visa and Mastercard were sleeping with stablecoin business. They are, Visa here launched stablecoins advisory. You have Mastercard explores stablecoin opportunities amid crypto interest. Mastercard stock rise amid strategic entry to stablecoin. You have these two businesses that are doing this. Look at this. Mastercard aims to enhance crypto capabilities by acquiring Zero Hash. This is the thing I saw when it comes to the latest acquisition. And maybe they will talk about Zero Hash during the earnings call. We are 10 minutes. Zero Hash. They don't talk about this acquisition. Do they talk about their acquisition? No, there are no questions from acquisitions. Interesting. It seems like nobody cares about their acquisition. Fair enough.
Players, we continue to position them for success in this new era of commerce, whether it be through consulting, security, data-driven insights, or new loyalty programs. We are there. Moving to commercial and new payment flows, one of our three strategic priorities. In 2025, our commercial credit and debit volumes represented 13% of our total GDV and grew at 11% year over year on a local currency basis. That's a clear reinforcement that our differentiated value propositions and broad-based partnerships are driving meaningful results. In commercial point of sale and invoice-based payment flows, our offerings are designed to meet corporate demands for more efficient, data-rich, and secure transactions. We continue to expand usage of our virtual cards by enabling transactions to be initiated within B2B and T&E platforms. Mastercard's Commercial Express program simplifies the integration and onboarding. This quarter, Embers, a leading T&E platform, and BMO and Huntington Bank were the latest issuers to participate. Differentiated solutions benefit our customers, and that has translated into significant wins. This quarter, we renewed our global partnership with WEX and extended our partnership with Barclays, the UK, and across Europe.
Okay, you know what? Let me skip this because that's about all the partnerships they signed, and listing all of them will not give you a lot of value. We are extending partnerships. We continue to expand our network. We are doing some partnership with some other countries. Blah 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 blah. You know what? Maybe we'll go through the Q&A session. Simply put, okay, they talk about their value-added services, how it is growing and wonderful. We have tokenized 40% of all transactions. For banks, that's a lot of data. We are embracing AI for our segment. We can be agile and trusted, and the acquisition contributed to 1% of the growth. Before discussing expenses, I am pleased to share that in late December, the company secured various new multi-year government grants. Okay. I would love to know more about their expenses. What do they have to say? No, they had some grants. Positively impact. Operating expenses were up 12%. 5% of which come from acquisitions. Oh, that's interesting. The revenue is up 1% more because of the acquisition, but the operating expenses are up 5% more because of the acquisitions. Interesting. Net income is up 20%. And they did some buybacks. You know what? We will maybe just skip to the Q&A session. Describe, no. Pricing and mix. Migration of the capital debit portfolio. Yes, this is fine. We saw a decline in some regions. And we have a resiliency, diversified business model. Okay, if they don't talk about their acquisition and if they don't talk about the new law, I mean, these are the two things we want to know from this call. So we already know the numbers. If they want to fire people. We expect to record a one-time restructuring charge in Q1, so it will be a cost of $200 million for severance pay. They will be recorded as a special item. These actions will impact 4% of our turnover. So they will fire some people, and it was expected. You had this piece of news. Mastercard to lay off 4% of its global workforce yesterday. So it's a recent announcement, which means better efficiency. You can do the same job, but with fewer employees. The margins will go sky high. Okay, wonderful. We have the Q&A session here. Let's see. So we want acquisition, and we want value-added services segment, more information, and we want the new laws.
Our first question comes from Will Nance from Goldman Sachs. Please go ahead. Your line is open.
Hi, thank you for taking the question. I wanted to start on the Capital One renegotiation. Congratulations on announcing that. Maybe if you could just provide a little bit more details. I think Capital One has talked about wanting to move volumes over to the Discover network over time, but at the same time, has talked about a lot of investments on the acceptance side. So can you talk about just the renegotiation as it relates to your existing Capital One cards outstanding? Are you expecting your share of Capital One credit volumes to remain stable as a function of the renegotiation? And if you could just maybe talk about how long the extension was for. I appreciate any details you can share. Thank you.
Okay.
Yeah, thanks for the question. So no surprise, we're excited about these recent news that we announced earlier. So extending our credit portfolio agreement with them is important, but also we should not overlook the aspect of Capital One as the great partner that they are to use more of our services across their whole business. It's a strong signal, in my view at least, that the Mastercard network is valued. This is important to consider. We continue to invest in this network. We continue to invest in our acceptance. We know this is hard to build, and that is really what matters when it comes to affluent portfolios, when it comes to business portfolios, and so forth. So the partnership will continue, but we will continue to invest to ensure that we have a truly differentiated proposition as a partner for Capital One.
He did not answer the question. 0 numbers were given, but yeah, fair enough.
Appreciate you taking the question.
Our next question comes from Sanjay Sakhrani from KBW. Please go ahead. Your line is open.
Thank you. Good morning. I guess I have a question on the CCCA.
Finally, that's it.
In the news flow.
That's the law. That's the law that is the main risk for Visa and Mastercard, and the reason why these stocks are dropping recently. So very, very important question. Great question.
I'm just curious how you guys are thinking about the implications to yourselves and the industry, and sort of the probability that it may or may not get through. And then just a quick clarification on the Capital One question. I'm just curious. It talks about sort of new accounts. Is there any volume migrating to Mastercard from Capital One? Or I just wanted some more clarity there. Thank you.
Good. Let's start with the first topic, CCCA. Sanjay, as you said, it's back in the news, and yeah, it's been back in the news, but yeah, it's been ongoing for a long time. So this was first introduced in 2023.
Yes, and they tried to have this law passed in 2023. It failed. They tried in 2024. It failed. They tried in 2025 by putting it in a budget law. It failed again. It's not the first time we try to have this law to pass, and it is failing. It's not new, actually.
And if you take it down to the facts, little progress has been made. A lot of discussions there around that, but also what clearly has emerged is that there's a very united opposition to this proposed bill, as the benefits of the bill are yet to be proven while the risks are pretty clear. That aspect is about taking consumer choice away from consumers. They can really pay the way they want to pay. That choice moves to merchants. This has been discussed in the context of affordability, but there's no particular consideration in this bill to actually pass on any savings. There's a big topic that is often overlooked, and that is the potential risk to cybersecurity. This is a race to the bottom for the cheapest network option, but not the safest. Those are all things that haven't really changed since 2023. But the opposition, based on focus on these points, has intensified. So the industry is very aligned. We're engaging with regulators at every point to educate and ensure that this is fully understood. So it's also important to understand that the payments ecosystem is highly competitive. Now, the Credit Card Competition Act isn't really about competition. It's about lowering costs without considering all the points I just said. So, there is competition. It's working. It's a highly effective ecosystem. So that is our perspective on it. That hasn't changed. On the probability of this going through, I mean, we shouldn't be speculating here. A few moves were made over the last couple of weeks, which haven't succeeded, and I think we attribute that to a continued discussion on the risk associated with this particular regulation.
Yeah, it reminds me of the book, of the talk from Peter Thiel. Basically, if you are a monopoly, don't say you are a monopoly. Say that you are in a highly competitive position, and it's very hard to do business. And when you don't have a monopoly and you're fighting for market share, a lot of companies will boast and will say they are the best because here are all the competitive advantages. You see what I did here for the call? Basically, you have a law that will maybe impact their beautiful duopoly, Visa and Mastercard, and they say, oh, it's a very competitive market. You know what? The credit card industry is so competitive. It's working. We don't want to change this market because it's competitive. There is competition and it's working. So it's a highly effective ecosystem. You see what I just did here? This is great. Good to know.
And then, Sanjay, your question around Capital One, it's like Michael said in his prepared remarks, right? We're really excited about the new agreement which we struck with them as it relates to new credit issuance. And, that's the extent of what we'll share with you publicly as it relates to the interactions. But suffice it to say, the reality is the customer sees real value with what MasterCard brings. That's the reason, we are actually doing what we are doing in the nature of the credit agreement. And, they're seeing that across the payment network as well as value-added services and solutions.
Thank you.
Our next question comes from Adam Frisch from Evercore ISI. Please go ahead. Your line is open.
Thanks, guys, and thanks for restoring some order in the marketplace as it relates to your stock this morning. I want to...
Sorry? Did an analyst just thank the management team because the stock is up 4%? How short-term is that? Okay.
Just go back to DC for a second. We wrote earlier this week that CCCA is all but dead for now, at least, but would love your views on the topic around a 10% rate cap on credit.
Second,
it seems
no.
like it's a back burner for now, but it's only a tweet away from being reignited. So would love your perspective on how you describe the conversations going on between the industry and the administration to address the affordability issue as it relates to our space. And then if you could also provide some insight around your conversations with issuers and other relevant players in the ecosystem about ways to address the president's concerns without creating a broader crisis in the industry. Thanks.
Good. Yes. Appreciate your first comment actually on the order. So
everyone is looking at the stock price, huh?
Well, the rate cap. It's a really important conversation around affordability.
By the way, speaking of the stock price, you have many people from Congress, from Senate, so US politicians that are big investors in Mastercard. I don't know, half of them are investors in Visa, and the majority of them are investors in Mastercard. You have a lot of people in the Senate, Congress that are invested in Mastercard. So if the stock goes down, all of them will lose money. It's highly unlikely they want the stock price to go down.
Share that it should be addressed. But when you think about the rate cap in particular, here is a proposal that comes with a whole range of consequences if you think through how something like this would be impacted. And the consequence that comes to mind first is, what does this mean to credit access for a lot of the most vulnerable people that may not have access to credit any longer should a rate cap like this be passed. So this is an important topic to be understood. To your question about our conversations with the banks, with the issuers, the card issuers, we don't set rates, but obviously we have a shared interest in making sure that the overall credit ecosystem does work and provides credit access. So we're sharing data. We're helping to compute what the impact would be, and then it is really understanding from our bank partners where they're going to go. Is it going to be different products? What is there today? Part of this is education. What kind of 0% introductory rates are out there today? Low interest rate products and so forth. So it's a broad conversation that's going on, and across the industry, leaning in on the topic of affordability and options around that. So I think overall a constructive dialogue that was sparked. We have yet to see. As I said, it doesn't affect us directly as we don't set rates, but we're actively engaged as an industry custodian.
Do you see the administration and the industry having more constructive talks about feasible alternatives here, as opposed to a blanket?
There's a live dialogue here. I think everybody realizes it's an important topic.
I mean, they say they are not being impacted, but there will be a little bit of an impact. I don't like their answer. Actually, you have two laws. One is about reducing credit card fees, swipe fees, like we have in Europe, when instead of having a 3% fee from Mastercard, it's like 0.2%. Fair enough. And their answer is, you want something cheap? Okay, but we will reduce the quality. Do you want the safest option or you want the cheapest option? So this is a good answer. But for the second point, having a 10% interest rate cap, banks will be affected, which means the whole credit industry will be affected. And millions of people in the US will lose availability to have borrowing, credit cards, going to the bank and asking for a loan because their FICO score is too low. If you impact the consumer, these people will consume less. So they will use their credit card less. So Mastercard will be impacted, less fees for Mastercard. So it's a trickle-down effect, second-order effect. But yeah, Visa and Mastercard will be impacted a little bit. Nobody knows how to quantify this, but you have a tiny bit of an impact. They say they are not being impacted because they are not the one putting the rules and the rates and the interest rates. Fair enough. But if you really have a 10% interest rate cap, you remove people that need credit. They will no longer have credit. They will no longer have access to credit. And banks will be affected because they make huge margins out of these people. But also, you have fewer transactions, lower volume. So Mastercard and Visa will be impacted. I don't like their second answer.
I think we need to move to the next question.
Okay, great. Thanks, guys.
Our next question comes from Ramsey El-Assal from Cantor Fitzgerald. Please go ahead. Your line is open.
Hi, thank you so much for taking my question. Michael, could you give us a view on the health of the consumer? It's a very noisy kind of media, political environment with a lot of mixed signals. On the other hand, it seems like the underlying spend volumes are really hanging in quite solidly across the board.
Yep.
What are you guys seeing out there? Any changing patterns, anything interesting to call out? Thanks.
Right. It's a great question. When you look back over 2025, over the whole year, and we just take soft data like headlines or consumer confidence data that comes out, on one hand, consumers fill in surveys at the same time, their spend behavior hasn't actually changed. So that's a pattern that just continues. We see, just taking 2025, it hasn't changed quarter on quarter. We see a truly savvy and intentional consumer. So what the digital economy brings to consumers comes almost back to the affordability topic, is an ability to figure out what's the best deal. What do you want to spend on? Where can you use your rewards to avail something that otherwise you might not do at this time? So is it a savvy and intentional consumer? They're using their loyalty programs, their data to kind of spend on what they want to spend on anyway. So that has been a continuous trend. There is question on how the consumer was affected or not, by some of the tariff changes that we've seen last year, and that doesn't show up in our data either. So it's not coming through somewhere across the ecosystem between importers and big brands. It's all been adjusted in a way that it hasn't really affected consumer spending. At least we cannot tell that. There's conversation on how does the whole spend pattern change when you look across higher income bands and lower income bands, and what we see across the board. In the light of a job market that is supporting paychecks and people are spending those paychecks, and the wealth effect on the other hand. So there are different types of supporting kind of factors around that support overall affluent spend as well as lower income spend. So that hasn't really changed. And Sachin talked about it earlier. The first 3 weeks into January, we see this continue. Now, if you zoom out and you look across the world, these patterns are different by region here and there, but the aggregate top line is that consumer spending remains healthy is the same.
Wonderful. So consumer is in good shape. So people will consume. People will pay with their credit cards. Nothing really changing here. Visa said the same thing. Banks said the same thing. I have followed some regional banks and some investment banks. They all say that the consumer is fine. Regardless of what you see on Twitter, if you look at the news, if you look at tariffs, people are spending.
Yeah.
Our next question comes from Craig Moore from ST Partners. Please go ahead. Your line is open.
Yeah, hi. Thanks for taking the questions. First, there's been quite a bit of FX volatility in the past week, which makes a nominal guide a bit of a moving target. Can you talk about the sensitivity of the overall business to FX rate moves these days, and when you set the FX rates for the guidance? And secondly, VAS grew.
Okay, for the first point, actually, I have covered this in my video before. FX foreign exchanges improved the performance a little bit, so that's a help.
Regardless of how I look at it, VAS growth accelerated significantly in 25 versus the growth in the rest of the business.
And the second point of this question, we actually looked at it before, a few minutes before. The value-added segment, value-added services segment increased in terms of importance. It grew 26%, and it is now 44% of the total revenue of the business. It is accelerating significantly.
And so I'm curious if this is a trend that we should expect to continue in terms of the relationship between VAS revenue growth and however we look at it, whether it's purchase volume or process transaction growth or whatever metric you prefer. Thanks.
Sure, Craig. So let me just take both questions here, which is from an FX volatility standpoint. I'll be humble enough to tell you I have no idea where FX volatility is going to be tomorrow, as it's going to be in the remaining part of this year. So what we do is we take our best estimates of what we think it's going to be. We look at long-term averages. We kind of look at, what the general environment is. And, on the basis of that, we build in our best estimates. In quarters in which we see outsized benefit come from FX volatility, we call it out, as we did in the first and second quarter of last year, right? And in other quarters where we see record low levels of FX volatility, we'll call it out as well, as I did today. So look, the reality is super hard to predict, right? And the impact to our business, as you can see, is the fact that I'm calling it out means it does have an impact on our business, in particular in the transaction processing assessments line, right? So that's kind of important for people to know where it kind of sits from an overall perspective. The more important thing here, though, is Mastercard is actually delivering some incremental value to our customers, which is why we actually generate the revenue associated with whether it's good volatility or bad volatility. The reality is we're delivering currency conversion services, which means that our customers are seeing value in terms of what we're doing, and it allows us to actually, participate in that volatility to the extent it's high, or then, the detrimental impact of that volatility to the extent it's low. So that's kind of point number one. On VAS growth, super pleased with the results. The company continues to be very focused. It's an important part of our various strategic pillars. You can see that the growth rates are healthy. I'll go back to what Michael said in his prepared remarks, right? Our business in terms of how we actually operate, our VAS portfolio is very tightly intertwined with what's going on in the payment network. Let's start there, right? The payment network brings volume onto the system. It brings data. Data enables the creation of VAS solutions, and that allows this virtuous cycle to keep going. As it relates to the growth, we continue to remain very encouraged about the growth prospects from a VAS standpoint. We shared with you previously what the building blocks of that growth are. Let's start with the fact that if there's underlying growth in drivers driven by, what we're doing in the payment network, there's an attach rate which is related to that, which actually helps growth take place. In our Investor Day, we talked about how approximately 60% of our VAS revenues are network linked. So if you see the payment network growing and the underlying drivers growing, you're going to see that the growth of that come through. Second, we're in the business of actually really increasing the attach rate to the extent there are new solutions we're putting out of the market. Doesn't mean that every new solution that we put out of the market is necessarily network linked, but those which are allow us the opportunity to continue that growth algorithm. Third, we're increasing the penetration of these solutions with our customers globally. So the color I gave you in my prepared remarks today about the fact that our VAS growth is broad-based gives me confidence that this is not episodic in one particular region. We kind of talked about how across AP, EMEA, and Americas, we're seeing good growth from a VAS standpoint, as also across the various elements of our services portfolio, we're seeing good growth. So that's kind of pretty comforting to me to see that we are actually executing across that VAS growth algorithm in a meaningful manner. And the last point I'll make is enabling this growth has been the constant look we do from an innovation standpoint organically, and we've done a bunch of new innovation which we've announced, but also what we're doing to expand our addressable market. And examples of that would be things like Recorded Future, which takes us into new and different and fast-growing spaces like threat intelligence. So if I had to bring all of this together for you, I'd say, good solid growth in VAS in 2025, and we continue to remain encouraged about the prospects from a growth standpoint, from a VAS standpoint, going forward.
Yeah, we're going to add a point here. This is, what's really important here is the differentiation, because when you look at the competitive landscape in services, there's specialist companies out there that focus on cybersecurity. There's loyalty companies out there. There's really not a company out there like us. So it puts us in a very differentiated position here. We have the payment data as Sachin laid out, and we can build a set of services that are truly unique. It's a very curated set of services. We keep getting the questions from you now and then, what is actually in services, but if you think about it from the perspective of cybersecurity solutions, data insight solutions, those are all, the types of services that ground it in fundamental growth drivers and needs of the growing digital economy. So differentiated underlying growth drivers, everything that Sachin just said, and all of this is powered by a significantly changing distribution network that we're using by selling these services through many others other than our payment partners.
Okay, so growth is expected to be strong, but they did not provide any guidance if the growth will continue to be at 25% per year. They said, yeah, we are growing in full force, people like it, and we expect to grow significantly in the future. But they don't say 15%, 20%, 25%. It's roughly in this range, but they are confident and they didn't highlight any risks. Also, they didn't say we are topping our growth rate and now it will decelerate. They could have said, yeah, 2025 was extraordinary, so don't expect that in the future, but we are confident. No, they said we are growing 25% and we are confident in the future. So actually, it's possible that in 2026, they continue to grow at more than 20% per year for this segment.
Thank you.
Our next question comes from Tien-Tsin Huang from JP Morgan. Please go ahead. Your line is open.
I appreciate it. Great growth here. I wanted to ask about Capital One a little differently. You mentioned, I think, Michael, you mentioned hundreds of issuing wins in 25. I'm curious with this year in 26, any updated call outs on timing and impact on, let's say, the KPIs from all these conversions or renewals
in 26? How does the renewal pipeline in general look, and any call-outs on pricing or competitive intensity, that kind of thing? Thanks.
Hey, Tien-Tsin, Sachin. Why don't I take the question? Look, I mean, again, from an overall customer engagement standpoint and a deal pipeline standpoint, I'd say coming into 2026 is, I'd put it in the realm of pretty normal for what we see at this time of the year compared to prior. So active pipeline, lots of great engagement taking place with numerous customers. Nothing unusual to call out there in terms of the pipeline of deals. As it relates to the competitive environment, we're in a competitive space. There's no question about it. And what we're also very clear about is that in a competitive space, you've got to differentiate. And differentiation is going to be driven by what we can do at the payment network level through our digital capabilities, but also what we can bring in the nature of value-added services and solutions. So this virtuous cycle piece may come into play again. And we're seeing ourselves actually be able to participate and actually grow in such an environment, which is very encouraging. So I think it's a competitive environment. We have, very what I would call formidable competitors out there, but, I feel very good about our ability to compete given our suite of services and solutions as well as our payment network capabilities that are out there. So net, here's what I'd share with you, which is feel encouraged about the robustness of the pipeline, and, we'll keep doing what we're supposed to do in terms of actually driving with our customers to deliver value to them. The last point I'll make is I don't expect, and I certainly hope that we don't win all deals. We want to win the right kind of deals. We've said this in the past, and we will be very focused on doing that, which is making sure that we want to win those deals which are fast-growing, which are cross-border heavy, which are ones where we can bring our
wins in the secular opportunity context are just as important as the plan for 26.
They talk about all their pipelines of deals.
Share with you. I'm not going to give you a full year rebate guidance, but what I will share with you is that in Q1, we expect our contra as a percentage of payment network assessments to be flat to slightly down sequentially compared to Q4, very much in line with what you've seen in the past.
Wolf Research.
Next question comes from Derek.
Hey, thanks, guys. Nice job. Just following up on guidance for a minute. When you look at the trajectory of it, obviously starting off, and then calling for maybe a slight acceleration as the year progresses to the high end of low double digits from the low end of low double digits. Maybe just remind us the puts and takes as the year progresses. And then more importantly, just the inputs. What are you assuming the consumer does, spend volumes do both cross-border, domestically? What are your thoughts on the potential for more stimulus? Is that embedded in your guide? So any more color on that would be great. Thanks, guys.
Sure, Darren. So our base case, which is the basis of the guidance that we've shared with you, is that consumer and business spending remains healthy. That's kind of our going-in position because that's what we've seen, right? And like Michael said earlier, there are different numbers as it relates to the soft data from a sentiment standpoint, and then there's the hard data. And that's what we kind of see. We've kind of triangulated around the best we can, and it's, our base case assumes a strong consumer. So that's kind of the starting point of, where we are from a driver standpoint. That contemplates, the dialogue around, a fairly healthy tax refund season, et cetera, all of that's taken into consideration. Again, recognize there's the U.S. and then we're a global business as well. We've got 70% of our business roughly coming from overseas markets. So I think It's important to kind of think about in that whole context. Now, I think you're asking the question as it relates to the cadence between the first half and the second half, which is something I shared. I've given you full year guidance, and I've kind of said that we expect the growth in the first half to be lower than in the second half, and that's primarily driven by the fact that you've got tougher comps from an FX volatility standpoint. We called this out last year where we talked about first quarter, second quarter of last year, higher FX volatility. I called out how we're seeing lower FX volatility, coming out of Q4 and into the first 3 weeks of January. Something to keep in mind. And, the reality is that's really what primarily explains the difference in cadence, which is there between the first half and the second half.
Okay. Thanks.
Just go ahead. Your line is open.
Great. Thanks very much. Sachin, I think you called out pricing as a driver across every revenue line this quarter. So just how should we think about the durability of what we're seeing come through across each of the line items, especially on cross-border, which has been it's seen a nice pricing tailwind over the course of the year. And then in terms of magnitude, just what you're building into the guide for 26 for pricing relative to 25. Thanks.
Yeah, I think it's important to actually understand how we go about thinking about what we do and what we call pricing as well, right? It's kind of very much a function of, what is the nature of products and solutions and services that we have delivered, whether they're brand new in nature and or they are, modifications or improvements in terms of delivering incremental value to our customers, which comes into play. So there is the impact of, what we've done last year. And not everything starts on January 1, so there's the lapping effect of that which comes through in the following year. And then what do we see in the nature of pipeline of new capabilities that will deliver incremental value to our customer that we will price for, that we build into our forecast? Trevor, I'm not going to get more specific than that as it relates to, how much of that there is, just because at the end of the day, a lot of this is a function of our ability to be able to deliver everything we've got in the nature of the pipeline in terms of new capabilities and new value, which will actually ultimately result in how much we generate in the nature of pricing.
Okay, fair enough. Thanks.
Our next question comes from Harshita Rawat from Bernstein. Please go ahead. Your line is open.
Hi, good morning. I want to follow up on your recent announcements on agentic, including the suite you just announced. It's early in this era, lots of experimentation happening, but maybe help us frame the different pieces of the capabilities here. You have the identity trust layer, now the platform for custom AI agents, but there's so much fragmentation and competing protocols. I know you're partnering with Google and OpenAI, among others. So help us frame this and talk about why you believe you'll see Mastercard not only growing in agentic era, but also thriving with respect to the trust, governance, personalization, and other services you can provide. Thank you.
This is a very interesting question. How will Mastercard grow in this era of AI agent? If you can connect your Mastercard card to ChatGPT, to OpenAI, to Gemini, how can you make everything work when it comes to cybersecurity? Because you will be able to pay with cloud, pay with any AI agent. So what are the things you are going to do in this AI world led by AI agent? A very good question.
Thank you, Harshita. This is a great question. What an exciting space. It might be one of those use cases, AI-driven use cases that meet our reality much faster than other AI use cases out there. So I think agentic commerce is going to come fast. So this whole idea of a consumer using an agent to drive, have a better commerce journey, I think that just resonates with people. You get better quality insights, you get better recommendations. So from that perspective, that's just kind of the starting headline, and hence when you then build out from that, we've been at this for over 8 months now with Agent Pay, launching that as our framework around recognizing agents, ensuring identity, and then bringing all the protections of payments into the world of agentic commerce. So those are all consumer protections and user experience journeys that are understood by consumers, also by our partners. Take a Google, for example. So this isn't new, and which gives me great confidence because it's understood and it can be delivered at scale. We are a really important partner in this whole journey. So there's new entrants, LLM companies that haven't been really in the commerce space, contrary to somebody like Google maybe. So yet again, that puts it on us to engage with these partners. From the outset, we ensured, as we do in other emerging payment spaces, that the standards are set. We put out protocols, others put out protocols. There's a question on how these protocols all interact with each other. Well, it's the focus on consumer protection, safety, security, and cyber, and registering agents and making sure they're real and all of that. That is really driving this, and these protocols generally reinforce each other. So from that perspective, we feel they're very centered here. The cards ecosystem brings a lot of value, and that is understood, and it will bring it into this space. So then you kind of ask yourself and say, well, from here on, what's different then? Well, new relationships are being built, and of course, we're stepping forward with a differentiated set of solutions that we can offer. We just talked about services earlier. That's an opportunity. You can start to see that there's a transaction opportunity in all of this because a basket might be spread over many merchants. So that's another opportunity. You could also see that the application of services, for example, tokenization, gets to see a very different path than it might see without agentic commerce. So these are all aspects that make me very excited about this. We're leaning across the ecosystem. Everybody wants to talk about this. If we take a step back right now, it's also true it's early days, but everything that I just said is true, and we're leaning for that. It's hard to predict when and how this is going to scale to what degree, but the train is leaving the station, and we're right in front of it.
Okay, basically they are going to welcome a new technological change the same way they did and they have done for the past 10 years. So yes, now you will be able to pay faster with a robot, with an agent, and Mastercard and Visa will still be here.
Thank you.
They will do many partnerships and it will work.
Our next question comes from Brian Keane from Citi. Please go ahead. Your line is open.
Yeah, guys, good morning. Congrats on the solid results. Sachin, I was just going to ask, when there's geopolitical risks, investors are always trying to figure out what the impact would be to MasterCard. And you talked about, levers and mitigation efforts that you guys use. Could you just talk a little bit about some of the things that you could do or pull or, things you've done in the past when political things have popped up to kind of mitigate downside to top line and bottom line? Thanks.
Yeah, it's a very important topic. We are probably one of the most global businesses, 220 countries and territories. So, as I said in my prepared remarks, we're monitoring geopolitics all the time. We have through the past years, and we're doing so today. It's really important for us to understand that this is not just about geopolitics. If you look at our business model, we're aligned in terms of our interest. With banks around the world. We're aligned with merchants and companies around the world. Our focus on driving an inclusive digital economy aligns us with broader populations and NGOs and so forth. So it's not just about the politics when you look at the geopolitical landscape, and we're engaging with all partners. An important aspect of this is we don't do the same thing everywhere. This is not a off-the-shelf kind of solution that MasterCard brings. We always strive to understand the local needs, the local considerations. Of course, it's very different in Africa. This is why we partnered with MTN. It's very different in the UAE versus Europe. We just announced in October last year that we're bringing 3 additional data centers into Europe, $250 million of investments on the ground to drive better resilience and competitiveness for Europe. So these are all aspects that we can do today because we've invested in our technology. We continue to invest in our technology. So some of the comments that Sachin earlier made about reprioritization and where we take charges, because that is what we need to fuel, that we have that flexibility to engage with a country on that path and be a true partner for that. At the same time, we bring global best practice and global cybersecurity solutions, and that sets us apart to navigate that world very actively. This will only work with a strong public policy and engagement process and spending time with governments and understand where they want to go. And that is what we do because we're in offices with 125 offices around the world to really stay very close to the local needs.
Yeah, and I guess, Brian, you asked what kind of levers do we have in uncertain environments to the extent we need to pull levers. I think the headline I would first say is that we will not do anything which will impair our ability to grow over the long term. I think that's super important. But all of that being said, there are several levers we've got. We've got levers which we've executed in the past in terms of taking a look at where are we expending our dollars. Are they in favor with our customers? Are they things which are going to deliver returns in the near term, medium term, or long term? And we will pull those levers. This could be across all our expense line areas, everything from personal.
This is so vague. So vague. Basically, the business is saying we will grow, but we will not tell you exactly why and how and what we will do exactly. But we will grow. This is the tone from the management team.
So now to our A&M spend, to our T&E, pro fees, you name it, right, at the end of the day. And also remember, we do have a component of our revenues which come with, cost of goods sold. And so if to the extent you're asking what kind of levers are there because revenues start to actually decline, revenues coming down has a natural effect of bringing cost of goods sold down as well. So sufficient levers, we'll never be complacent around this, but I do want to leave you with one thought, which is we do care about investing for the long term, and that's something we will continue to do through up and down cycles because the set of opportunities in front of us is so big that we shouldn't lose sight of that.
Good.
Thank you very much. Michael, any closing comments?
Yes. So we just spent the past hour talking about our diversified global business and how we're winning in the market. None of this is possible, of course, with our colleagues around the world, the dedicated teams. I mentioned it twice earlier in my remarks, and we're proud about the work that's being done for our customers. We're also grateful.
Congratulations to the team. I will fire 4% of all my employees. Okay, fair enough. So the earnings call gave us a little bit more information about the new laws. Basically, they said the resistance is fine. You have a lot of opposition in this industry. So the banking lobby is very, very strong. all the banks, JP Morgan, Bank of America, Goldman Sachs, and all the regional banks are already opposing the new act, the new laws in when it comes to credit cards, swap fees, etc. And Visa and Mastercard are opposing these two laws, and they have arguments for this. So I think it's quite a low probability of it happening, which means it's a buy the dip opportunity. The call has not changed my conviction. Actually, the call has increased my conviction that if you invest in Visa and Mastercard, nothing ever happens. You know, these companies will get more profitable in 5 years. They will have more revenue in 5 years, more net income in 5 years, more buybacks in 5 years, more free cash flow in 5 years, more earnings per share, free cash flow per share in 5 years. And you can have these deals right now. You can have the opportunity to buy these two companies right now. So you can choose your fighter, Visa and Mastercard, depends on what you want. Visa has better margins, Mastercard has better growth and more diversified business model with value-added services segment. But anyway, we are talking about an industry right now that has done nothing. If you look at their stock price, no results for the past year, while the market is shooting higher and higher and higher, which causes the valuations to drop. So pretty good report, extremely good report actually. The call gave us some confidence that nothing ever happens for Mastercard. They are getting more profitable and they see many growth opportunities in the future. If you like this content and you want to go deeper, I have a coaching program. In this program, you will learn the strategy I use to outperform the market. You will learn how to find winning opportunities. You will learn how to properly value stocks, when to buy, when to sell, so that you can build a strong portfolio with great companies. Additionally, inside the program, you will have access to an exclusive community of like-minded investors, and you will also have access to my personalized guidance to reach your investing goals. Click the first link in the description to get more information. You will get a short video that explains how everything works, completely for free. No need for your email address, just click the first link in the description and I'll see you on the other side.